The New Orleans Conference, the world's greatest investment event.
Good afternoon, ladies and gentlemen. I'll have to assume you're smiling at me. These stage lights are incredible and I can't see anything, which is probably useful. At the beginning, I'd like to say I've been speaking at this conference for probably 30 years now, and as I have done every year since his passing, I would like to acknowledge and thank the founder of this conference, the late James U. Blanchard. For those of you who knew him, he was a wonderful human being. And I'm sad he couldn't be with us here today, but the fact that Brian London and this wonderful team has kept on this conference in his honor is, I think, very, very admirable. Nice, too, to be here after the last couple conferences. The last couple conferences, I sort of felt like I was a master handholder. My contrarian versus victim was beginning to wear a bit thin. People had told me that they had been contrarians so long that in fact they felt like victims. I think it's safe to say, with regards to gold at least, that we are in a gold bull market. Can you advance the slide, please? Maybe I can advance the slide. Let's see what happens. Whoops. Now I got to unadvance it. Well, we'll start with that one. Okay, perfect. This is a 100-year chart of commodities valuations. Looking, of course, at your left, you can see where we were 100 years ago, and you can see where we are now. Those of you who have suffered through my speeches for years know I don't normally trouble myself with charts because I can't make these things work. But I thought that this chart would save me a lot of talking. I would draw your attention to a few things about this chart. First of all, the incredible cyclicality in resources, the incredible volatility in resources, but probably more importantly, when you look at this chart, and I want the audience to help me with this, I'm an old slow guy, do we look like we're closer to the top or to the bottom? I want to test everyone's perception with regards to this. That isn't to say that we couldn't go lower or we couldn't go higher. I just want you to look in terms of valuations over 100 years where we are here, where we are now. And I want to point out to you that there are a few reasons for this. One of them is really wonderful. Human beings are truly wonderfully inventive, and we find ways through technology to improve the utilization of resources, improve extraction. So the costs associated with producing resources relative to other values in society and relative to the premium that we can attract for our labor and intelligence continue to go down. This is truly a wonderful thing. But that's been true over time, and as you can see, despite technology, on occasion, when the economy grows fairly rapidly, we run into periods where there's resource shortages and the market really, truly explodes to the upside. Remember that these are capital-intensive businesses. This is important for you to remember. And during the down cycle, what happens is that there are substantial disinvestments in natural resources. People go into liquidation. People who are losing 50, 60, 70 cents a pound making copper, or $20 a pound making uranium, are in no hurry to increase their production, given how much money they're losing on their current production. The consequence of that is that when reserves run out, there is no more of the commodity. The other truism of commodities, particularly in an era like this, where technology allows you to do so much with basic materials, is that the price of commodities ends up being a very small component of the cost of producing finished goods and services. In other words, the value add is worth more than the stuff that goes into the good that you're sold. And this is important because it makes demand for commodities, at least in the near term, fairly inelastic with regards to price, meaning that if the price of something goes up, in the interim, it doesn't impact demand for it very much. And so prices can shoot. When you look at the chart, you will see what happens when periods of low prices do their job. You can also see the ultimate result of that. With resources, we like to say that the cure for low prices is low prices, and the cure for high prices is high prices. And while this isn't the main story today, I thought that putting the next story in the context of a 100-year chart for commodities, and a very graphic exposition of where we are today, is something that is in order. Make no mistake, we are going to have a commodities bull market. I don't think that we're on the cusp of it. I'm no economist, but I have observed some aspects of financial history, at least the 45 years of it that's transpired since I've been an investor. And what I've learned is that a recovery of the type that we're in, as tepid as it may be on a global basis, a recovery that's a 9-year-old recovery is probably a recovery that's long of tooth, that is closer to the end than to the beginning. And particularly a recovery that has been, at least I believe, driven in some substantial measure by artificially low interest rates, is a recovery that feels to me fairly fragile. And if we have a synchronized global slowdown in the world economy over the next 2 or 3 years, supply shortages in commodities notwithstanding, I don't think that there's a lot of upward pressure. Which is to say that that low point that you see on that chart, which is where we are now, doesn't need to spike like we have seen before. We could easily have a rolling bottom in the commodities business. But make no mistake, the cure for low prices is in fact low prices. The bullish theme on commodity is easy to establish. There's 7.3 or something like that billion of us, and every day there are becoming more, not less. And everybody around the world aspires to the life that you live, and increasingly, the increase in living standards at the bottom of the demographic pyramid in the last 30 years has been astonishing. And all of those people want to live like you live, and increasingly some of them are able to do it, and so compete with you for resources. So the long-term case for natural resources is in fact a bull market. But that isn't today's news. Today's news is precious metals. If you could advance, let me see if I can do it. I might not need help with this. Wonders never cease. Wonders never cease. This is the Barron's Gold Mining Index. I use it because Barron's has the longest gold mining equities index in the business. So again, when you look at this chart, I will point out a few things to you. The first is, relative to history, it's pretty obvious that we are approaching the bottom, at the bottom, or just off the bottom. You can see that simply with the visualization on the far right side of the chart from your viewpoint. But the second thing that I want to point out to you is the incredible upside and downside volatility of gold equities. For some reason, this audience likes upside volatility more than downside volatility. I don't know what that's about, but anyway, if you look at this chart, you'll see that in the 9 previous recoveries from oversold bottoms, the recoveries have varied from between 200% for an anemic recovery to 1,200% for a robust recovery. Now, this is important news, and as you look at the chart, you see that they take place over fairly compressed periods of time, 18 months to 46 or 47 months. So the first thing I want you to take away from this is that we are close to or at or just off the bottom, which is a very good thing. The second thing, though, is that if history repeats, that is, if this chart works its magic one more time after having done it 9 times, the upside that we're going to see is somewhere between 200% and 1,200%, and we're going to see it over a period of 18 months.